Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Align Technology created the clear aligner category with Invisalign. Headquartered in Tempe, Arizona, and founded in 1997 by Stanford students, it received FDA clearance in 2001 and has since treated more than 15 million patients worldwide.
Invisalign replaces metal brackets with custom clear plastic trays that gradually move teeth into position. The trays are nearly invisible, removable for eating and brushing, and changed every 1 to 2 weeks as treatment advances.
The clear aligner segment generates about $3.2 billion annually, 89% of total revenue. The iTero intraoral scanner business contributes $400 million. Together, they form an integrated digital orthodontics platform.
The brand moat is substantial. Over 300,000 doctors globally have been trained specifically on the Invisalign system. That training investment creates high switching costs. Clinicians rarely abandon a system they've mastered for a less familiar alternative.
The iTero scanner amplifies the moat. Dentists using iTero get digital scans that feed directly into Invisalign treatment planning, making Invisalign the lowest friction choice from a workflow perspective. Scanner adoption drives case starts in a measurable, documented way.
Gross margins approach 70%, high for a medical device company. The intellectual property embedded in each aligner set and the premium the Invisalign brand commands over generic competitors supports this margin structure.
International revenue is roughly half of total sales. Europe, China, and Asia-Pacific are important growth markets. Macro softness and regulatory dynamics can create quarter-to-quarter volatility in international volumes, even when the long-term adoption trend is intact.
CEO Joe Hogan joined in 2015 after running ABB, the Swiss industrial conglomerate. His global operations experience has been useful as Align scaled manufacturing and distribution across multiple continents with complex regulatory requirements in each market.
The competitive landscape is less threatening than it appears. Direct-to-consumer aligner companies have struggled with quality and liability. The clinician-supervised Invisalign model benefits from those failures.
Align does not pay a dividend. Free cash flow funds R&D and manufacturing expansion. The balance sheet carries limited debt relative to the company's earnings power and cash generation.
The orthodontics market remains large and underpenetrated. Many adults who could benefit from alignment have never pursued treatment. Improving aesthetics, shortening treatment time, and reducing costs could expand the addressable patient population substantially.
Cases shipped per quarter and average selling price are the metrics to track. Volume reflects adoption. Pricing reflects whether Align is holding its premium against lower-cost aligner competitors entering the market from below.
A clinical trust advantage built over 25 years and reinforced by 300,000 trained doctors is not easily displaced. And that is the foundation of the Align investment case.
Understanding the iTero to Invisalign flywheel and the doctor training ecosystem is what gives you full context for reading the case volume numbers every quarter.
That's the company chapter for Align Technology. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Align Technology just dropped a Q1 2026 print that punched above the bar, and the stock still fell 3.3%. Revenue $1.04 billion, up 6.2% year over year. Non-GAAP EPS $2.58 against consensus near $2.29, a 12.8% beat. Record clear aligner shipments, $200 million in new buybacks. So why did the tape sell off? This is Charged Alpha. Let's break it down.
Align Technology is the company behind Invisalign, the clear plastic aligner that replaced metal braces for millions of orthodontic patients. They also make the iTero intraoral dental scanner, a digital impression system used in dentist and orthodontist offices to design those aligners. Align owns roughly 85% share of the clear aligner market globally. Market cap is $12.5 billion. The business is a near monopoly in a category they essentially invented.
The investment story has two layers. Layer 1, Invisalign cases. Volume growth tied to dentist adoption, teen orthodontic cycles, and international expansion. Layer 2, iTero scanners. Hardware sells the recurring aligner workflow that follows. Gross margin is 67.3%, premium medical device territory. The tension into Q1 was simple. Had the consumer slowdown in elective dental procedures bottomed? Today's print says volumes are recovering.
Total revenue for Q1 2026 was $1.04 billion, up 6.2% from $979 million in the prior year quarter. That topped the consensus estimate of $1.02 billion by roughly 1.8%. Clear aligner revenue specifically came in at $856 million, up 7.4% year over year and up 2.1% sequentially. The aligner business is re-accelerating after a soft 2025.
On unit volume, and this is the headline number, Align shipped 685,700 Invisalign cases, a record. That's up 6.7% year over year. The mix matters. Orthodontist volumes were up 7.4%, while general practitioner volumes were up 5.6%. The orthodontist channel is higher margin and more durable, so seeing it grow faster than GP is a quality signal embedded in that volume number.
iTero scanners and imaging systems generated $184 million in revenue, up about 1% year over year and down sequentially as expected. Q1 is always seasonally soft for capital equipment in dental offices. The number of scanners sold to brand new doctor accounts grew double digits year over year. The active iTero installed base now exceeds 125,000 units globally. That installed base is the funnel that feeds aligner volume.
Margins held up well. Gross margin landed at 67.3%, growth. Align operates at a software-like gross margin despite being a medical device company. Adjusted operating income came in at $223.8 million versus the street's $201.5, an 11.1% beat at the operating line. Non-GAAP operating margin tracked above 21% for the quarter.
The balance sheet is fortress grade. $1.08 billion in cash against just $114 million of total debt. Net cash of nearly $1 billion. Trailing 12-month free cash flow of $593 million. Operating cash flow for the quarter was $223 million. Total equity is roughly $4 billion. Zero refinancing risk, zero credit cycle exposure.
And alongside the print, Align announced a brand new $200 million share repurchase authorization. With the stock down meaningfully from its all-time highs, management is signaling that current levels look like value. Combined with the cash balance, Align has the firepower to repurchase aggressively without touching the credit markets at all. That's a confidence statement, not a financial engineering trick.
Wall Street remains broadly constructive on Align. Coverage breaks down to 7 buy ratings, 3 holds, and 0 sells. The average analyst price target is 206.86. With the stock trading around 174.53, that implies roughly 18% upside to consensus. Evercore raised its target from 200 to 220 post-print, which is one of the more constructive calls on the sell side.
On valuation, the stock is genuinely compressed. Forward PE is around 15.5 times, well below where Align historically traded during its growth stock years when multiples regularly exceeded 40 times forward. Price to sales is about 3.1 times. For a near monopoly with 67% gross margin and $1 billion in net cash, those are reasonable absolute multiples by any framework you want to apply.
The bull thesis on the sell side rests on 3 pillars. First, clear aligner penetration globally is still in single digits versus traditional braces. Multi-year volume runway remains. Second, the iTero installed base feeds compounding aligner demand. Third, margins should expand as international scale builds. None of those 3 pillars require heroic assumptions about consumer spending.
The hold ratings cluster around 2 specific concerns. First, average selling price pressure. Align's lower-priced DSP touch-up product is growing faster than the premium full case, which dilutes blended ASP. Second, the fiscal 2026 non-GAAP operating margin guide of around 23.7% is below where the street had originally modeled. Margin is the bull case. Guidance below expectation is what the holds are pointing at.
The market reaction tells the rest. ALGN fell 3.27% the session after the print, despite beating on revenue, EPS, and operating income. The interpretation, the beat was driven by volumes and discipline, not by margin upside. Investors who came into the print expecting a margin inflection got volume strength instead. That's still a good outcome, just not the upside narrative the multiple needed.
The bull case starts with global penetration. Clear aligners still represent under 15% of orthodontic case starts worldwide. In emerging markets, that figure is closer to single digits. The total addressable case opportunity is in the tens of millions of patients per year. Align owns the brand, owns the workflow, owns the scanner. That's the entire stack.
Pillar 2 is the teen orthodontic cycle. Teens drive a meaningful share of case volume, and the cohort is structurally insensitive to short-term consumer cycles. Parents prioritize the teen treatment window regardless of macro conditions. Q1 case shipments at 685,000 units suggest that teen demand is back on trend after a soft 2025.
Pillar 3 is international leverage. As iTero scanner placements scale outside the US, every new scanner becomes a long-tail aligner annuity. International orthodontist adoption is accelerating in markets like Germany, China, and Brazil. The combination of a dominant brand, a fortress balance sheet, and structural underpenetration is precisely the setup that re-rates a stock once macro headwinds clear.
The bear case starts with the consumer. Clear aligners are an elective procedure costing several $1,000s out of pocket for most patients. When household budgets tighten, that spending gets deferred. Beta of 1.81 tells you the market has already priced ALGN as macro-sensitive. When consumer confidence weakens, this stock leads the move down.
Competition is the second pillar. 3M's Solventum spin-off still competes in clear aligners. Ormco operates in adjacent orthodontic categories. The era of SmileDirect Club-style direct-to-consumer aligner brands didn't end the threat. Successor companies continue to chase the lower price segment that Align's DSP touch-up product was created to defend against.
Third, the margin guide. Fiscal 2026 non-GAAP operating margin guidance of about 23.7% sits below where the street modeled. Consensus had been closer to 25%. That's roughly a 100 basis point gap, and at Align's revenue base, it's around $40 million in operating income that has to be recaptured later in the year.
The fourth concern is mix. The DSP touch-up case is helping volume, but it's a lower revenue, lower margin product than the flagship full case. As that mix shifts, blended ASP declines even when total cases grow. Investors paying for a premium margin medical device franchise need to see the high-end mix hold, or the multiple eventually compresses to reflect the new reality.
Align doesn't have a clean public market peer in clear aligners. The closest comparable franchises sit in dental device adjacencies. Dentsply Sirona, ticker X-Ray, is the largest pure-play dental products company. They sell consumables, implants, and imaging equipment to the same dentist offices that buy iTero scanners. X-Ray has been a chronic margin disappointment story, while Align has been the share gain story.
Hologic, ticker HOLX, is a women's health and diagnostic imaging company, different end market, but a useful margin benchmark for premium medical devices. Hologic operates in the high 50s gross margin range. Align's 67.3% gross margin sits meaningfully above that bar, which is what makes Align fundamentally a more attractive franchise on profitability.
SmileDirect Club, ticker SDC, was the publicly traded direct-to-consumer aligner pure play before its bankruptcy. Its collapse is part of why Align's competitive moat looks more durable today than it did 3 years ago. The capital that funded DTC aligner experiments in the late 2010s has largely retreated, leaving Align with strengthened pricing power in the orthodontist and GP channels.
The bigger picture. There are very few healthcare names with 67% gross margin, $1 billion in net cash, 85% category share, and a sub-16 forward PE. Most healthcare devices trading near that valuation come with either growth deceleration or balance sheet baggage. Align has neither. That combination is the entire setup for the bull case.
Options markets priced Align's earnings move at roughly 5.5% in either direction heading into the print. The stock moved about 3.3% down, within the implied range, so the straddle didn't pay aggressively. Implied volatility crushed predictably the morning after the report, which is the standard pattern around mid-cap healthcare earnings.
Open interest in the July 2026 expiration is concentrated at the 180 and 190 call strikes, suggesting traders see room to run if margin guidance gets revised higher mid-year. Put open interest sits at 160 and 150. That's downside hedging from holders who like the long-term thesis, but worry about a deeper consumer slowdown bleeding into Q2.
On insider activity, recent transactions are limited to scheduled 10b5-1 plan sales, small dollar amounts relative to the executive equity grants. There has been no cluster of unscheduled selling and no insider buying of note. That's a neutral signal. Management isn't aggressively defending the stock with open market purchases, but they're also not signaling concern.
Institutional ownership is dominated by Vanguard, BlackRock, and a long tail of healthcare-dedicated funds. The $200 million buyback authorization announced with the print is meaningful relative to the $12.5 billion market cap, roughly 1.5% of shares outstanding at current prices. Align doesn't pay a dividend. The buyback is the entire capital return story.
Bottom line on Align: dominant franchise, premium gross margin, fortress balance sheet, and a stock down meaningfully from highs, trading at 15.5 times forward earnings. The volume recovery is real. The margin recapture is the open question.
If you own ALGN, the thesis tightened today. Record cases plus a buyback signals confidence. New buyers should size for the 1.81 beta and accept the margin reset. Charged Alpha rates this a constructive long, high-quality compounder at a reasonable price.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.